The Japanese yen is an absolute freefall. Since the start of the year, Japan's currency has fallen 10% versus the US dollar, pushing it to its lowest level since 1990. What's going on and what does it mean for the fourth largest economy in the world? Let me explain. So the main reason for the yen's decline has to do with interest rates. You might have seen headlines earlier this year about how Japan's central bank, the BOJ, hiked interest rates for the first time since 2007. But that hike, made back in March, was largely symbolic. You see, for much of the past few decades, Japan has been battling deflation, a phenomenon in which there's a broad-based decline in prices across the economy. Deflation can cause all sorts of problems by encouraging consumers and businesses to hoard cash rather than spending or investing it. So the Bank of Japan tried a bunch of things to try to get rid of deflation and spur prices in Japan to rise. And one of the things that it did was cut interest rates to ultra low levels. We're talking about interest rates at zero and even below zero. Unfortunately, those policies didn't help all that much. Outside of a few exceptional years, prices in Japan remained in a rut. That is, until 2022. What happened then? Well, that's around the time that economies around the world started opening up after the COVID pandemic. For a number of different reasons, as this reopening happened, inflation took off everywhere, and Japan was no exception. In 2023, Japan's core consumer price index grew by 3.1%, its fastest rate of inflation in over 4 decades. And unlike in other countries, inflation in Japan was welcomed. After years of fighting deflation, the Bank of Japan was thankful that prices were finally on the rise. So as the BOJ grew more confident that the price increases were sustainable and that deflation was in the rear view mirror, it started talking about normalizing monetary policy by hiking interest rates from their ultra low levels. That's what the rate hike in March represented. It was the first step in this normalization process. That hike took the overnight bank borrowing rate in Japan from negative 0.1% to a range of 0 to 0.1%. But as you can see, that still leaves rates in Japan close to zero. And they're probably going to stay around there for a while. Although the BOJ has said that it'll likely hike rates again this year, it's also said that raising rates is going to be a gradual process. Because after all, the country had been battling deflation for decades. The central bank doesn't want to do anything that might cause the economy to fall back into that quagmire. That means that even though interest rates in Japan will probably go up from here, they're going to remain at extremely low levels for quite some time. That's in sharp contrast to the situation in most other countries, like the US, where interest rates are much higher. In the US, the Federal Reserve has set the benchmark federal funds rate to a range of 5.25% to 5.5%. And in recent weeks, expectations have grown that the central bank is going to keep interest rates at those elevated levels for longer than people had thought because inflation is proving to be more stubborn than people had thought. So you have short-term interest rates in Japan at around zero, and you have short-term interest rates in the US at over 5%. That's a big difference. And what that does is encourage money to flow from Japan to the US as well as other countries where interest rates are higher. The Japanese in particular have been big buyers of foreign bonds. In order to purchase those foreign bonds, they sell their yen and buy currencies that those bonds are denominated in, like dollars and euros. That drives the value of the yen down. But it's not just the Japanese who are selling yen. Because interest rates in Japan are so low compared to other countries, a lot of traders around the world are borrowing money in Japan at low rates and using that money to invest at higher rates elsewhere, a strategy that's known as a carry trade. So that's why the yen is selling off so much. It's because of large interest rate differentials between Japan and the rest of the world. That raises a question though. What does the steep decline in the yen mean from an economic perspective? Well, for the Japanese economy, a falling yen is both good and bad. On the one hand, it increases the cost of imports for Japan. Any goods purchased from other countries are going to be more expensive for Japan. The country is particularly vulnerable to higher import prices when it comes to food and energy. Japan relies on imports to meet 90% of its energy demand and upwards of 62% of its food demand. On the other hand, a cheaper yen has benefits for Japan as well. It makes profits generated by Japanese companies overseas more valuable when converted back to yen. It makes makes Japan a more attractive destination for tourists, and it makes Japanese exports more competitive on the world market. So there's pluses and minuses when it comes to the weaker yen, and Japanese authorities are weighing these various factors when they look at the sharp decline in the currency. They like how the cheaper yen is fueling Japanese exports to record levels, and how it's encouraging foreign companies to set up shop in Japan to take advantage of the currency's decline. What they don't like is how households are having to pay so much more for things like food and energy. So that's the trade-off that's happening as the yen weakens. And based on comments from Japanese government officials, they seem to be okay with this trade-off as long as it happens in an orderly way. When the yen's decline becomes disorderly, they've pledged to take action to bring stability to the market. For example, in 2022, when the yen lost nearly a quarter of its value versus the dollar in a matter of months, the Japanese government stepped in and purchased the equivalent of around $60 billion worth of yen using its stockpile of foreign currencies. That put a floor under the yen for around a year. Now with the yen starting to make new lows versus the dollar again, the Japanese government has threatened to intervene once more. In fact, while the government has yet to confirm it, there are indications that it may have intervened this week with purchases of more than $35 billion worth of yen. We'll see if that's enough to stem the decline in the yen in the coming weeks. Okay, so now you have a sense of why the yen is going down and what it means for the Japanese economy. But that's just my interpretation of things. As you can tell, I'm not that worried about the decline in the yen, and I don't think it'll have a major impact on the Japanese economy, let alone the world economy. There are others, though, who are much more alarmed by the drop in Japan's currency. This tweet from Robin Brooks, senior fellow at the Brookings Institute, encapsulates many of those bearish views. He agrees that the yen is falling because interest rates in Japan are so low. The problem, though, according to him, is the only way to stop the decline is by hiking interest rates. But the Japanese government can hike interest rates because doing so would cause a fiscal crisis, presumably because at higher rates the Japanese government wouldn't be able to afford to pay the interest on its debt. In other words, Brooks is suggesting that Japan is in a box. It can't hike interest rates when it should hike interest rates, and that's causing a currency crisis. Now, leaving aside the issue of whether Japan can or should hike interest rates more aggressively, that in and of itself is debatable. What I'm skeptical of is this idea that Japan is in a currency crisis. Yes, the yen has fallen significantly, and it might continue to go down further from here. But should that be characterized as a crisis? As I pointed out earlier, there are both good and bad consequences stemming from the yen's decline. But not even the negative effects, like higher food and energy bills, are big enough to cause a dramatic impact on Japan's economy. There's also another thing that I haven't touched on yet, which is that the biggest beneficiary of the yen's decline is the Japanese government itself. The government holds massive reserves of foreign currencies like dollars and euros, last estimated to be worth around $1.3 trillion. As the yen has fallen, the value of these reserves in terms of yen has surged, giving the Japanese government a windfall with which it can use to occasionally support the Japanese currency like it did in 2022 and earlier this week. Japan also has a current account surplus, which means that it takes in more money from the rest of the world than it pays out. And the yen is a reserve currency held by central banks around the world. Neither of these are typical of a country prone to a currency crisis. Not to mention, Japanese stocks are at all-time highs and the Japanese economy is still growing, which again aren't things you would expect for a country experiencing a crisis. So the bottom line is this: the yen is falling because of large interest rate differentials between Japan and the rest of the world. This has both good and bad effects on the Japanese economy, but it's not causing a crisis. Where the yen goes from here will be determined by a ton of different factors. Movements in interest rates, trade and investment flows, economic growth, and speculation. No one knows exactly where the yen is going to bottom out. The dollar-yen exchange rate could go to 200 like some people are predicting, or it could fall back down below 140 where it was a year ago. Who knows? What we do know, though, is that at some point equilibrium will be reached and the yen will stop going down. Japan's currency is currently trading at all-time lows in real terms. That means that adjusted for purchasing power, the yen has never been cheaper relative to other currencies. So if you've been thinking of taking that trip to Japan, well, now is as good a time as ever to do it. Hope that helps, and follow for more investing insights.